Welcome back to Investing Talk Podcast. Today we're tackling a question that I know is on many of your minds. Is WeRide, the Chinese autonomous driving tech company, is now a good time to buy? We've gathered, well, quite a stack of material on the company, looking at its financials, its market position, valuation, and, what the future might hold. Our mission, like always, is to sift through all this, pull out the key insights, and give you a clear picture so you can decide what it means for you. And hey, before we dive in, if you're finding these deep dives helpful, please take a second to subscribe, like, and comment wherever you listen. It really helps us bring more of these analyses to you. And if you're feeling extra supportive, maybe consider buying us a coffee. Every little bit helps keep this going. Okay, let's get into this company. WeRide. It went public on Nasdaq back in October 2024. As of June 23rd, 2025, it was trading around $7.51. But, that number doesn't tell the whole story, does it? This stock has seen some major volatility, down 47% year to date.
And an even bigger drop, something like 83% from its 52-week high, which was way up at $44.
Wow. So, yeah, we're looking at a company with clearly strong tech, good partnerships, but also its current valuation and the market conditions, well, they present both big opportunities and, frankly, some pretty substantial risks.
Yeah, what's really interesting here is just how fast the story can change for a growth company, especially in a new sector like this one. WeRide is kind of the perfect example. Huge long-term potential, but also facing some very real short-term headwinds.
Okay, let's start with the money side then. How did WeRide actually do financially in Q1 2025? The numbers we saw looked a bit of a mixed bag.
That's a good way to put it, yes. So the company reported revenue of RMB 72.4 million. That's about $10 million US. Now, year-over-year growth was pretty modest, just 1.8%.
Only 1.8%.
Yeah, but, for a company in such a tough competitive space, even that small growth shows some, let's say, resilience.
Right. And what about profit? Because we always hear about tech companies just burning through cash. But I saw something interesting about their gross margin.
Yes, that's a really critical point here. While the revenue growth was small, their gross profit margin in Q1 was 35%.
35%. Wow.
Which is actually quite impressive. It's industry leading, in fact.
Right.
It suggests that their cost management is effective and that the underlying tech platform can generate real value once it scales up. Product revenue, for instance, went up from about 6.5 million RMB to 9.5 million year over year. Service revenue helped too.
Okay, so strong gross margin, that's a positive sign. But the flip side, I guess, is that they're still losing a lot of money overall. Is that right?
That is right, yeah. Despite those good signs, WeRide still faces pretty substantial net losses. In Q1 2025, the net loss was RMB 385.1 million, so about $53 million US.
Ooh, still a big number.
It is, but it is an improvement from Q1 2024, when the loss was closer to RMB 468 million. And the loss per share improved quite a bit, too, from nearly RMB 12 down to RMB 1.38.
Okay, so progress on stemming the losses, but still deeply in the red.
Deeply unprofitable, yes.
So you've got this company losing money, but it has that strong gross margin, improving per share metrics. What about the balance sheet? Do they have enough cash to keep the lights on and keep funding all that R&D?
Yeah, that's the next logical question. And this is actually where WeRide looks remarkably strong, financially speaking. They have a very healthy balance sheet, about RMB 6.13 billion, which is roughly $845 million in cash and equivalents.
$845 million.
Yeah, a huge cushion. Based on their current burn rate, that gives them more than 3 years of operating runway.
3 years. That's significant.
Very significant. And their total debt is tiny, only about $14.8 million. So the debt-to-equity ratio is super conservative, just 1.6%. Total assets way outweigh total liabilities. It points to a really solid financial foundation.
Which is absolutely crucial for a tech company needing heavy R&D investment, right?
Exactly. That cash buffer is key to staying competitive.
Okay, so that strong balance sheet is definitely a plus, especially in a capital-hungry market like autonomous driving. Tell us a bit about that market and where WeRide fits in.
Well, the autonomous driving market itself is projected to grow pretty significantly from about $36 billion this year, 2025, to over $83 billion by 2035. That's a compound annual growth rate of about 8.7%. So robust growth.
Big pie to go after.
Definitely. And WeRide's already got a decent global footprint. They're operating in over 30 cities across 10 countries now.
So huge growth area. They're already global. What about their actual products? How do they compare? What are they offering?
Their position is helped by having a pretty comprehensive portfolio. They're doing robotaxis, robobuses, robovans, even robo-sweepers.
Robo-sweepers, okay.
Yeah, but the robotaxi revenue is key. It reached RMB 16.1 million in Q1, making up over 22% of their total revenue. And that share is up significantly, about 10 percentage points year over year. So it shows they're getting traction commercializing that core tech.
Sounds like they're doing a lot, tackling multiple angles, but who are they actually up against? Is it a crowded field?
Oh, absolutely. It's incredibly crowded. They face intense competition from, the big established players like Waymo, Tesla, Cruise, and also strong Chinese competitors like Baidu Apollo and Pony.ai.
So heavy hitters all around.
But WeRide does have a first-mover advantage in some specific markets, and their partnerships with global OEMs, the car manufacturers, that gives them some important differentiation. It suggests they're carving out a niche, even with those strong rivals breathing down their neck.
Okay, so we've got financials showing, let's say, progress, but still losses. A strong competitive spot in a growing market. Now, here's where it gets really interesting for investors, for you listening. How on earth do you value a company like this?
Yeah, that's the tricky part. The valuation metrics for WeRide, they paint a pretty complex picture. Market cap is around $2.14 billion. Their trailing 12-month revenue is about $50 million. So that gives them a price-to-sales ratio, the PS ratio, of about 21.
21 times sales. That sounds very high.
It is very high. It clearly reflects massive investor expectations for future growth, but it also signals, potential overvaluation based on current fundamentals.
And obviously, we can't use a traditional PE ratio, price to earnings, because they don't have earnings yet.
Correct. Yeah, no PE possible. Their earnings per share for the last 12 months were negative $1.25. The price-to-book ratio is about 4.8x, which is elevated, sure, but maybe not totally out of line for a tech growth company like this.
How does that PS of 21 compare to others in the autonomous driving space? Is everyone trading this high?
Compared to many others, WeRide's valuation does look a bit stretched, yeah. That 21x PS is higher than a lot of established tech companies. However, you could argue it's justified by their potential in this huge AV market. And it's true that many AV companies, even those losing money, are trading at premium valuations right now.
So what does this all mean for the current stock price then? Is there any sense of its intrinsic value?
Well, one intrinsic valuation model we looked at based on base case scenarios suggested a fair value of only around $1.09 per share.
Wow, $1.09 versus the current $7.51.
Yeah, which would indicate the stock might be overvalued by 86% at current prices. Now, that's just one model, but it really highlights how speculative the current valuation is and how much it depends on them executing perfectly on their growth plans.
Okay, switching gears a bit. Let's look at how the stock is actually behaving. What's the technical analysis telling us about the price action?
The technical picture is, frankly, pretty bearish across multiple time frames. The stock's trading below all the major moving averages, the 5-day, 20-day, 50-day, 200-day. They're all acting as resistance levels above the current price.
So a clear downtrend then. No ambiguity there.
Pretty clear, yeah. The stock established this downtrend after hitting that $44 high back in February. Right now, the price seems to be finding some support down near the $6 level, which is its 52-week low.
And are the other technical indicators confirming this bearish view?
Yes, pretty much across the board. Key indicators paint a bearish picture. The RSI, the Relative Strength Index, is down near 36, heading towards oversold. The MCD indicator is negative, showing negative momentum. Williams Persor confirms selling pressure. The stochastic oscillator is way down below 20, indicating severely oversold conditions.
Okay, so strong sell signals flashing then. But you mentioned oversold. Does that imply anything for the short term? Could there be a bounce?
The summary from multiple technical sources is indeed a strong sell. However, those deeply oversold conditions, they do suggest a potential short-term bounce might be possible, a relief rally perhaps.
Got it. And what about volatility? You mentioned the big drop earlier. Is the stock just generally jumpy?
Extremely jumpy, yeah. WeRide shows really high volatility. Average weekly moves are almost 20%.
20% in a week.
Yeah, compare that to the market average of, say, 7 or 8%. This stock's volatility is higher than 75% of U.S. stocks. So it makes it interesting for active traders maybe, but potentially quite challenging for long-term investors who prefer stability. It's a roller coaster.
Definitely sounds like it. Okay, let's move beyond the numbers and charts now. What's actually happening with the company? Any recent news or developments that could impact things?
Yeah, there have been several pretty significant developments announced this year in 2025. A really big one is the expansion of their partnership with Uber. They're adding 15 more cities globally. And Uber is putting in another $100 million equity investment.
Another $100 million from Uber. That's a big vote of confidence.
It really is. It's actually one of the largest AV collaborations announced so far.
Okay, that's huge. What else? You mentioned global reach earlier.
Right. They also launched the first fully driverless robotaxi testing in the Middle East over in Abu Dhabi. And they introduced 8 24-hour robotaxi routes in central Guangzhou, a major Chinese city, plus announced expansion into Saudi Arabia.
So pushing forward on multiple fronts.
And another interesting thing, the board authorized a $100 million share repurchase program.
Buying back their own stock. Signaling they think it's undervalued.
That's typically the signal, yes. Management showing confidence.
Okay, interesting developments. What's the analyst community saying about all this? Are they bullish? Bearish?
Well, analyst coverage is still pretty limited. Only a couple are covering it formally. But those who are seem generally positive. The 2 analysts have buy ratings with an average price target around $22.
$22, that implies. Wow, almost 200% upside from here.
Huge potential upside, according to those targets. But recent analyst activity shows some mixed signals, too. Wall Street Zen apparently upgraded it from sell to hold in June, but then downgraded it back to sell pretty quickly after, so some indecision there.
Okay.
And the stock's also been hit by just general sector rotation, competitive news. Remember, NVIDIA just closed a stake earlier in the year. That gave it a temporary boost.
Right, I remember that.
But it's declined since then amid the broader AV sector challenges.
Okay, so looking ahead then, what specific things should we, or you, the listener, be watching for? What could actually act as a catalyst to move the stock?
Good question. Near term, say the next 3 to 12 months, key catalysts would definitely include regulatory approvals. The CEO himself has stressed how important government regulation is for getting the industry to profitability.
Makes sense.
Also, executing on that expanded Uber partnership, getting those deployments up and running in the 15 new cities, that will be crucial to show they can scale commercially.
Prove the model works widely.
Exactly. And then just continued development of their level 4 autonomous driving tech and expanding their fleet beyond the current, 1,200 vehicles.
Okay. And longer term, say, looking out 1 to 5 years.
Longer term, it's really about the overall market maturing. That projection of the global AV market hitting over $2.3 trillion by 2030. If that happens, the rising tide could lift boats like WeRide, especially the robotaxi part of it, and developing clear regulatory frameworks worldwide that could really benefit companies like WeRide who are already operating and have that first mover advantage in some places.
Creates more certainty.
Right. And finally, just technology convergence. Things like 5G networks becoming ubiquitous, AI getting even better, sensor tech improving, all that should accelerate AV adoption.
Okay, lots of potential catalysts there, both near and long term. But where there's potential, there's usually risk. What should listeners be really aware of on the downside here?
Absolutely crucial to consider the risks. WeRide, yes, strong tech, strategic position, growing market. But it faces some really significant challenges, company-specific risks. Number 1 is probably the uncertainty around profitability. When will they actually make money? The CEO admits getting there in 5 years depends heavily on regulations and partnerships, and meanwhile, they're still burning through a lot of cash.
Despite the revenue growth.
Despite the revenue growth. And then there's that intense competition we talked about, from rivals who are often much better funded.
Right, and what about risks tied to the whole autonomous driving sector itself? Things beyond WeRide's control.
Big ones there, too. Regulatory uncertainty is huge. Laws are still evolving, and different places might have conflicting rules, adding costs and complexity.
Yeah, a patchwork of regulations.
Could be. There's also technology risk. AVs are still emerging tech. There are still technical hurdles. And any safety incident, even if it's a competitor, could really hurt public trust in the whole sector.
Yeah, a setback for one could be a setback for all.
Possibly. And then there's consumer acceptance. Will people adopt AVs as quickly as hoped? That could limit market growth if adoption is slow. And finally, you've got the broader macro risks. Geopolitical tensions, especially for a Chinese company operating globally. Economic downturns could hurt demand for these services.
And that volatility we mentioned earlier is a risk in itself.
Definitely. That 19.9% average weekly swing,
Yeah.
it means the price can move dramatically for reasons that have nothing to do with the company's fundamentals. That requires a strong stomach.
Okay, so pulling it all together. Impressive tech, strong balance sheet, big market potential, but also deeply unprofitable, very highly valued, fierce competition, lots of risks. If you had to sum up the overall investment recommendation from the sources we looked at, what would it be?
The overall rating from our sources comes out as a 4 out of 10. so leaning cautious.
Hmm.
For more conservative investors, the recommendation is to look for an entry price maybe between $5 and $6.50. That's down near those 52-week lows where there's some technical support.
Okay, and for someone more aggressive.
Well, if you really believe in those high analyst price targets, maybe an aggressive entry could be considered around current levels, say $6.50 to $7.50. But really, the optimal entry for maximum margin of safety would probably be waiting for a clear break below $6.
Got it. And what about suitability? Is this stock right for everyone?
Definitely not. For short-term trading, maybe moderately suitable. The high volatility creates opportunities for active traders, and it is oversold, suggesting potential bounces. But it needs really careful risk management because those swings are so unpredictable.
And for long-term investment?
Generally not recommended for conservative investors. The potential is there, yes, in the AV market long-term. But WeRide's current valuation, the ongoing losses, the uncertain path to profit, it's just too speculative for them. It might be appropriate for aggressive growth investors, people with a really high risk tolerance who understand the speculative nature.
Okay. And if someone does decide to trade it, any guidance on managing that trade?
The guidance suggests setting a stop loss around $5.75. That's about 25% below the current price, near that 52-week low support, to limit potential losses if it keeps falling. For take profit targets, maybe $9.50 short term, aiming for that 50-day moving average resistance, $12 medium term, hitting a previous support level, and maybe $18 long term if you're aiming closer to those analyst targets.
And position sizing?
Keep it small, no more than maybe 2–3% of your total portfolio, just because of that extreme volatility and speculative nature.
Okay, that makes sense. So WeRide is definitely a fascinating case study. The whole AV revolution is transformative, no doubt. But the current risk-reward profile here, based on our sources, seems to favor patients waiting for better entry points, or maybe looking at more established players in the sector instead. What's the big takeaway for you from all this?
I think if you connect it to the bigger picture, WeRide's story really highlights that inherent tension you always see when investing in genuinely transformative technologies. It's that constant battle between the incredible potential of the future versus the very real, very difficult financial and operational challenges of actually getting there.
Yeah, bridging the gap between vision and reality.
Exactly.
Yeah.
This company is kind of a microcosm of the whole industry trying to make that leap.
And that's a really crucial thought to leave with you, the listener. As you think about WeRide, consider how that balance between the technological promise and the harsh market realities, how that's going to play out. Not just for WeRide, but for the entire autonomous vehicle industry. It's a story that's definitely still being written, and we'll be here to keep you informed as it unfolds.